All right, let's dive into a real labyrinth in the tax code. Differential wage payments for military employees. Now, if you're a payroll professional, this is a super critical area. It's a place where one small, seemingly correct entry can, believe it or not, unexpectedly trigger a major IRS audit. So let's break down exactly how to get it right.
So here's our game plan for this explainer. We're going to build this up step by step. We'll start by defining what these payments actually are in the eyes of the law. Then we'll pinpoint the central paradox that creates all the audit risk. After that, we'll debunk a really costly myth about combat zones and wrap it all up with a practical checklist to keep you compliant.
Okay, first things first, what is a differential wage payment? I mean, what does the law actually consider it to be? Getting this definition right is absolutely crucial because the HART Act of 2008 basically laid the foundation for all the tax treatment that comes after.
The cornerstone here is Internal Revenue Code Section 3401H. Before this act, these payments were kind of in a gray area. They were often just reported on a 1099 MISC. The HART Act changed everything by clearly defining them as wages for income tax purposes.
So, for a payment to even qualify, it has to pass both of these tests. And that first one, the more than 30 days rule, it acts like a huge switch in your payroll system. Think about it. If an employee's service is 30 days or less, it's just treated as standard wages. But the second those orders cross that 30-day mark, the entire tax character of that payment changes completely.
All right, let's get to the main event, the Core Compliance Challenge. This is the reason these payments trigger so many IRS notices. It's this contradictory tax treatment that's right at the heart of the whole issue.
I know. That sounds like a paradox, right? But it's exactly how the law works. Under that IRC Section 341H, they're considered an employee who's receiving wages for income tax withholding, but then for FICA and FUTA taxes, because they aren't physically performing services for you, the civilian employer, that employment relationship is seen as suspended.
And this table, it just perfectly illustrates the problem when it comes to the Form W-2. Box 1, which is governed by the HART Act, must include the differential pay. But then you look at boxes 3 and 5 for Social Security and Medicare, and those are governed by Revenue Ruling 2009-11. They must exclude it. So what you get is this intentional discrepancy that the IRS's automated systems are literally programmed to flag as an error.
So let that sink in for a second. A perfectly compliant W-2 in this situation looks identical to a W-2 with a huge error. It makes it look like you've underreported Social Security wages. And that's exactly why the burden of proof falls right on you, the employer, to document and be ready to defend this intentional difference.
Now we've got to tackle one of the most common and costly mistakes that both employers and employees make. It's this assumption that civilian pay somehow becomes tax-free if the service member gets deployed to a combat zone. It's a really common question, and honestly, your gut reaction is probably, yeah, that seems right. But when you look at the regulations, the answer is crystal clear, and it's not the one you'd expect. The Treasury regulation is totally explicit about this. The combat zone tax exclusion, which is authorized by IRC Section 112, applies only to military pay from the Department of Defense. It does not, under any circumstance at the federal level, apply to supplemental wages from a civilian employer. The rule is all about the source of the payment, not where the person receiving it happens to be.
This table really shows the unique tax situation that results. You can see service members get this kind of half-tax benefit on each stream of income. Their military pay, it's exempt from federal income tax, but they still pay FICA on it. And their civilian differential pay? Well, that's exempt from FICA, but it's always subject to federal income tax. So neither income stream is ever completely tax-free. Okay, so moving beyond just staying compliant, the law actually gives employers some important ways to support service members through their retirement plans. You can even get a tax credit for doing it.
Now, this is a huge provision from the HART Act. It makes sure that deployed employees can keep making 401k contributions from their differential pay. Before this, since DWP wasn't technically wages, it often couldn't be used for planned contributions, which basically froze an employee's retirement savings while they were deployed.
And get this, for eligible small businesses, the law provides a direct financial reason to offer this kind of support. Internal Revenue Code Section 45P sets up a general business credit that's equal to 20% of the total differential wage payments made to an employee.
As this IRS guidance shows, there are some specifics you need to know. The credit is calculated on the first $20,000 of payments, so that's a max credit of $4,000 per employee.
It's only available to employers with fewer than 50 employees, and you have to provide these payments under a formal written plan. You claim it all on IRS Form 8932.
So just when you think you've got all the federal rules figured out, you have to deal with state laws. And the most important thing to remember here is that states do not always follow the federal tax code.
What's happening in Pennsylvania is a perfect example of this. While federal law always taxes differential wage pay, Pennsylvania explicitly says it's exempt if the service member is in a combat zone. And that creates a really complex payroll situation where you have to keep withholding for federal taxes but stop withholding for Pennsylvania state taxes for the exact same payment.
The big takeaway here is that you just can't assume that states follow the federal rules. I mean, states like California do, which makes DFW taxable there. But if you're a multi-state employer, a state-by-state analysis for every single deployed employee is an absolute must to make sure you're getting state income tax withholding right.
So, with all these complex parts moving around, how do we build a plan we can actually use? Let's put together a checklist that not only keeps you compliant, but also builds your defense file before an audit notice ever shows up. Okay, these are the 3 main data mismatches that will automatically get your returns flagged. We've talked about the W-2 mismatch. Well, a very similar mismatch happens on your quarterly Form 941, where your total wages on line 2 will be higher than your taxable Social Security wages on line 5A. And finally, if a civilian employer mistakenly uses code Q in box 12, that's an immediate red flag, because you're not the Department of Defense.
This brings us to the most practical step, actually putting these rules into practice. Think of this checklist as your game plan. You need to create a dedicated pay code. Make sure it maps correctly to the W-2. Verify it's eligible for retirement plans. Claim that Section 45P credit if you can, and, maybe most importantly, keep internal records that reconcile those Form 941 variances. Seriously, that documentation is your audit defense file.
Ultimately, every payroll professional has to answer this question about their own system. Getting this configuration right isn't just a best practice, it's really the only way to safely navigate this part of tax law. Hopefully, this explainer gives you the tools you need to answer that question with confidence and turn what could be an audit risk into a compliance success.